Now the part of our show, as always, where we talk about three things that individual investors should be focused on before they make your investment decisions. And as I guess everybody would say, this is a pretty popular part of our show. Our first one, U.S. job numbers update this Friday. Well, we were supposed to get U.S. job data this Friday, but due to the government shutdown that's currently ongoing, that started at midnight, I guess this morning or last night, the U.S. government is closed right now, and that data, unfortunately, may not be provided to us. However, we did get ADP numbers, which are private payrolls, which are private jobs, and those numbers were actually somewhat disappointing this morning. So we'll talk about that and what may or may not happen. Take emotion out of investing. I think this is extremely important. A lot of emotion out there. When you say the word president or the two words, President Trump, that elicits such emotion from so many people. You either love what he's doing or you don't like what he's doing, and there doesn't seem to be much in between. You have to take emotion out of investing, and that is something that individual investors need to consider always, not just over the next couple of weeks, but always. Understand what is happening in the markets and why. Again, with this chase for profit that we're seeing, many individuals are asking me questions. Should I be more into the Toronto stock market? It's going higher. It's outperforming the US markets this year. Is that something that we should have more of, more names that trade in Toronto? Well, I think you need to understand why the Toronto stock market is going higher before you can actually consider owning more TSX names. So understanding what you have and understanding why it's moving higher is clearly very important. So let's take our first point, US job numbers update this Friday. And as I said, we may or may not get these job numbers if this government shutdown should end very quickly, started this morning. And if it should end, let's say later today, I think it is very possible we could still get those numbers. Canadian jobs numbers do not come out until the following Friday, which I believe is October 10th. And we'll get those jobs numbers in Canada. And if they are weak, as they have been over the summer months, over the last few months, then I think we are a shoo-in for another quarter point basis cut by the Bank of Canada. Our first charts here show some data that we did receive. One is the JOLTS number, which are job openings and labor turnover. And you can see the job openings are falling. There are not as many jobs available in the US. And on the right-hand side, you can see hires and total separations. So hires are also kind of flatlining, slightly down. What we're actually seeing in the US is that people aren't really getting fired, but they're not hiring new individuals either, which is quite interesting. Those that are retiring or deciding to leave the business is just not hiring new people to replace them. They're asking for the existing workforce at that company to pick up the slack, to do more. And so, we're seeing hires not go up. We're seeing fires not go down or go up either. We're not seeing as many job openings because companies are just not hiring. So we're just seeing a bit of a stagnant situation. Our next chart here shows the most recent data out of the US. And there you have it, showing very little job growth, excuse me, over the last few months. 22,000 jobs created last month in the month of August. And you can see over the last 4 months, we've had a lot of job disappointment, a lot of negative revisions. And the jobs number that was supposed to come out on Friday was going to go a long way as to tell us whether the Fed will consider or cut, or the likelihood of the Fed to cut rates at the end of October. We won't get, I don't believe, the October number before we get a rate decision by the Fed. So this number was going to be the last one, and hopefully we will get that jobs data at some point in the not so distant future, so all of us can figure out what the Fed has on their minds and what they're going to do. Our next, our topic or point that individual investors should be considering before you make, as I mentioned, always, if you make any investment decision, not just an investment decision over the next 2 weeks, but an investment decision just in general. And that is, you need to take emotion out of investing. And sometimes your emotion tells you to do one thing, But the smart money is doing the total opposite. When stocks or investment ideas are trading at low points because people are nervous, there's volatility out there, the headlines are negative, that's the time where you got to gather up the courage and buy. And the times when everybody's buying, there's that chase for profits. Everybody's talking about buying stocks, whether it's AI, technology in general, bank stocks, whatever it is. Your next door neighbor telling you that they're making lots and lots of money. That's when you probably want to be cautious. And whenever we talk about the emotion side of things, always I like to show the cycle of emotions, which is our first chart in this segment, investment emotional cycle. And you can see here right in the middle is the point of maximum risk is actually at the point where the markets are at its highest. So yes, we would say that right now, with markets at all-time highs, yes, we're at maximum risk because to keep or make new highs, to stay at these highs or make new highs, things have to continue to go great. I don't want to say perfect, but they have to be fantastic for us to see the markets continue to move higher or individual stocks continue to move higher. And as I mentioned right away off the top of this segment, the point of maximum fear is when the best time to invest. That's when the markets are at the bottom. And as you can see, you have the best potential for moving higher. So taking emotion out of investing, I think, is the number one thing. As an investment advisor myself, that's what I try to do. And a lot of people will say to me, Allan, I love Apple. I own all their products. They just had a launch of new iPhones. Everything looks so great. The new sleek, very thin iPhone. It's popular. It's this. Shouldn't we own shares of Apple? Well, maybe, but I can tell you that Apple stock has gone nowhere this year. Recently, it's gone up, and earlier in the year, it went down. So if you look at where Apple traded in and around end of December last year, it was about $255, $260 a share. And guess what? Here we are at the beginning of October, almost 1 year later, and the stock is in the exact same place, 255, 260. So again, if you let emotion get the best of you with respect to buying Apple stock because Apple can do no wrong and you're part of that environment, the whole Apple ecosystem, well, I think you would have been disappointed watching many other stocks move higher or investments moving higher, and Apple just didn't move higher. And what causes this emotion? Well, headlines. Headlines in the news, headlines from President Trump, headlines from Prime Minister Carney, and some of the headlines that we put together for you here, some of them, or many of them, actually negative. One at the top there, as tariffs hit, people grapple with rising bills and multiple jobs. Another recession indicator as consumer confidence declines. Lumber hit with new Trump tariff sector calls. It's misguided. Trump selling a strong economy. Voters aren't buying it. The one at the bottom, hit by Trump tariffs. Rest of the world races to forge new trade alliances. All of this gets you going, right? It gets you going. It gets you thinking. Either you love what the president's doing with some of these headlines, or maybe you just don't. And it's not just President Trump. You have a lot of headlines that come out of certain companies. I get calls from people every day. Allan, it's so nerve-wracking right now. The economy is in shambles and all of this, should we be selling? And I say to that person, I say, economy in shambles, I don't know what you're referring to. But if, you're looking at the stock market, if you're right and the economy is slowing down, which yes, it is, stock market's at all-time highs. So emotion, if you let the emotion get the best of you, you're just not going to make the right decisions when you need to make them. And an investment advisor is there to help you, keep emotion out of it before you make your investment decisions. Our third topic, which is off the top, where I said you need to keep in mind before you make your investment decisions, is this idea of understanding why things happen the way they do. One of the questions I get often is, TSX, Allan, is outperforming the US market this year. Maybe we should own more Canadian stocks than stocks outside of Canada, stocks outside are in the US. And I say, well, do you understand why Canada Stock Exchange is doing so well? And the investor will say, I'm not so sure. Well, our first chart will show you exactly this. And it is a great chart, one of my favorites, possibly my favorite for the show. It shows you the different sectors of the Toronto Stock Exchange And I know it's a little blurry, but if you look at the purple, which is the top line, it shows a roughly 68% increase. That sector, if you look along the top, is the materials sector. And what is it part of the materials sector? Gold. So one of the main reasons why the Toronto Stock Exchange is doing as well as it is because of gold. Gold stocks. Gold hit or is around $3,900 an ounce US today, this morning, before I came on air. Gold stocks have been the primary driver of what's been going on here in our country. Yes, Canadian bank stocks have had a fantastic run. It's made a lot of money over the past, let's call it 9 months or so. Your big five Canadian bank stocks have done extremely well, but nothing in comparison to what gold has done. So you look at gold, you look at banking. Banking makes up about 31%. Gold, not as much, maybe 13-ish%. Oil makes up about 17% of the Toronto Stock Exchange. We know oil hasn't really done anything this year. Price of oil has been hovering around $63 a barrel, WTI, for oil. So really, it's been gold. And that's what I mean. You need to understand why things move the way they are. So if you want to own gold stocks, sure. But if you're going to look at other sectors that aren't as volatile as gold, because I still believe gold is higher risk, then maybe you don't want to own many stocks on the Toronto Stock Exchange that trade on the Toronto Stock Exchange, because there aren't really that many good performers outside of the banks, outside of gold. You have a bunch of others. Celestica's done well from a tech perspective, Shopify, but you got to be careful. You got to really understand why things happen the way they do. Our next chart here is another example. And I actually had this question from an investor not that long ago. And this investor said to me, we can put up the chart, the next chart, Allan, Tesla. How can Tesla be worth so much money today as a car company when if you compare what Tesla does to the other car companies sell way more cars than Tesla, yet the market cap of Tesla, what it's worth today, is so much higher. And he's 100% correct. Look at this chart. Tesla, $1.4 trillion it's worth today. Ford, $46 billion. General Motors, $55 billion. Stellantis, formerly Chrysler, just under $27 billion. The three car companies put together are still, what, not even half, a fraction of what Tesla trades at in terms of market cap. And then you look at car sales, 633,000 for Tesla, and the others are to over 2 million, 2.08, 2.7, 1.3. So why would Tesla trade so high? And this is where you have to understand why. Well, simple answer is because Tesla is not trading like a car company. Tesla is trading like a technology company. That's why you can give them the high multiples, whether it's right or wrong. And I'll show you a little later in the show what their multiple is. And it's something that kind of scares investors because it's so high. But it's the future potential of Tesla. It's the robotics. It's the robo-taxis. It's all the AI, the grok, artificial intelligence. It's the future. And that is why individual investors will continue to invest in Tesla, because they believe in Elon Musk. So when you want to compare Tesla to these other car companies, there is no comparison. So when someone's trying to say, well, this is silly, I don't want to buy Tesla. Well, if you're doing it, or if you're looking at Tesla as a car company, for sure, you're not going to be a buyer. But many people are buying Tesla because they're looking at it from a futuristic standpoint, and in the hopes that Tesla will, grow into their valuation at some point when the robo-taxis come and the robots come, because that's what Tesla represents to many people. So understanding why you're looking at things to buy, why they're higher, why the index is higher, this is so important. And you couple that with the data, economic data of the U.S. Hopefully we get a jobs number coming out of the day on Friday, and taking emotion out of investing. That is obviously something, as I mentioned, that individual investors need to do always. And if you look at these three things, I think it's going to help all of you make better investment decisions. And hopefully, you can own some good quality names, trading at nice multiples, and understanding what you own when you buy them.